Usually when we look at a period of massive money printing, the script is incredibly predictable.
Right. It's the classic inflation hedge playbook.
Exactly. I mean, the central bank turns on the taps, fresh liquidity floods the financial plumbing, and risk assets, especially finite supply capped assets like Bitcoin, they just go absolutely parabolic.
We have seen it time and time again. More dollars injected into the system inherently means, more dollars chasing the exact same number of coins.
But then you look at the last couple of years, and that predictable script just totally broke.
Yeah, it really did.
The central banks pumped the system, right? They expanded global liquidity, but it completely failed to push Bitcoin past its October 2025 peak. And meanwhile, tech stocks went on this historic tear.
It is this massive central paradox.
Right. It's left so many capital allocators just staring at their screens, totally bewildered.
Well, that broken correlation is really the defining macro divergence of this cycle. And the answer to why it happened is not some random glitch in the crypto market.
No.
It is the result of a massive, unprecedented capital absorption machine operating in the background, which is fundamentally altering the flow of global liquidity.
So today we are opening up a plain, source-cited briefing on exactly that mechanism. Welcome to the Deep Dive, everyone.
Glad to be here.
Today's mission for you, the listener, is to unpack the recent reality test essay by BitMEX co-founder Arthur Hayes, along with some really detailed analyses we pulled from Benzinga, NewsBTC, and CCN.
Yeah, there is a lot to get through.
There is. We are looking at a $1.5 trillion macroeconomic thesis that explains the AI debt mountain, the suppressed Bitcoin bid, and how you should be positioning your portfolio right now. And just to set the tone, there's no hype today. Just the math and the structural flows of capital.
To really understand the sheer scale of what is happening, we have to look at two parallel sets of numbers that line up with, honestly, eerie precision.
Okay, let's unpack this, because the math here is where this whole thesis pivots.
It's the foundation.
Yeah. We have to start with the lead, and it is a striking dollar-for-dollar coincidence. Let's look at the U.S. M2 money supply.
Which is a crucial metric.
Right, and for anyone casually listening, M2 is basically the measure of all the cash, checking deposits, and easily convertible money floating around in the system.
The readily available liquidity.
Exactly. So between November 2022, which not coincidentally is when ChatGPT launched, and today, the M2 money supply expanded by roughly $1.5 trillion.
That is just a staggering amount of fresh liquidity.
It's massive.
And historically, a very specific percentage of that new money naturally bleeds into speculative assets.
Yeah.
It looks for the highest possible beta, right?
Right.
Which heavily favors the crypto complex. But this time, it just vanished.
It vanished because over that exact same window, from November 2022 to today, AI companies issued roughly $1.5 trillion in debt to fund the build-out of new data centers.
What's fascinating here is the structural conclusion forced by those two identical numbers. The AI sector essentially acted as a perfect $1.5 trillion sponge.
A sponge, yeah.
It absorbed every single dollar of new liquidity before it could find its way into Bitcoin. I mean, the balance sheets match almost perfectly.
I love visualizing this kind of macro plumbing.
Yeah.
Imagine the Federal Reserve turning on a massive fire hose of liquidity.
Okay, picture that.
Right. They aim it at the broader financial markets, expecting it to, pool out and raise all the boats in the harbor.
The wealth effect?
Exactly. But right in the middle of the harbor, the AI industry opened up a giant sinkhole.
Wow.
Every single drop from that fire hose was swallowed by data center capital expenditures. I mean, we're talking buying land, securing power grids, ordering NVIDIA chips. It swallowed it all before it could even ripple out to other assets.
Because of that sinkhole, as Hayes bluntly puts it in his essay, Bitcoin never had a chance to capture the excess liquidity.
Right.
Now, to maintain context, Bitcoin did rally strongly off its November 2022 low.
It did.
It climbed from around $15,000 after the FTX collapse all the way to roughly $125,000 by October 2025.
But even during that massive run, AI equities were still wildly outperforming. I mean, NVIDIA, for example, pulled off an 11x move over that exact same period.
Yeah, 11x is just wild.
But the real divergence, the part that mathematically proves the sinkhole theory, happens after October 2025.
Since Bitcoin's peak in late 2025, it has fallen 50%. But NVIDIA rose another 10%.
It just kept going.
We have to ask why the correlation completely fractured at that specific moment. And the answer lies in the aggressive pacing of that $1.5 trillion in AI debt.
The timeline of the debt issuance is absolutely the smoking gun here.
It really is.
Of that total $1.5 trillion, a massive $1.3 trillion of it was issued from 2025 onward.
So almost all of it.
Yeah, literally, just as Bitcoin's rally stalled out and started its descent, the AI debt binge kicked into its highest gear. It completely vacuumed up the remaining liquidity in the system.
Which brings us to the urgent stakes for capital allocators right now. We have to understand the fundamental difference between voluntary capital flows and forced capital flows.
Okay, walk us through that.
Well, this entire mountain of AI debt is predicated entirely on future expectations of growth.
Now, wait, let me push back on this for a second.
Sure, go ahead.
Because the intuitive leap a lot of investors make goes like this. Let's say the AI bubble pops.
Okay.
The expectations aren't met and valuations crash. If $1 trillion leaves the AI sector, shouldn't that be incredibly bullish for crypto? Doesn't all that sideline capital just instantly rotate back into Bitcoin?
That is the standard assumption, and it is a wildly dangerous one.
Why is that?
If we connect this to the bigger picture of how modern credit markets actually function, a massive drawdown in AI equities does not result in voluntary capital rotation. It results in capital destruction.
Let's actually walk through the mechanics of that, because capital destruction sounds abstract, but it's very real.
Extremely real.
Think about how this $1.5 trillion was deployed. We aren't just talking about people buying stocks with cash.
No, not at all.
We're talking about an explosion of stock margin loans. So if I'm a massive tech firm, I might pledge my highly inflated AI stock as collateral to a bank, right?
Right.
And borrow billions against it to build a data center.
And banks have aggressively extended those massive credit lines based on the assumption that those AI stock valuations will hold or go up.
But if they don't?
Exactly. If those stocks suddenly crater, the collateral backing the loans is no longer sufficient to cover the debt.
The bank looks at the falling stock price and they issue a margin call.
The dreaded margin call.
Yeah. They demand cash immediately to cover the difference. And if the tech firm doesn't have the cash, the bank forcefully liquidates the stock, driving the price down even further.
So the money doesn't rotate into crypto.
No. It literally disappears into a black hole of debt repayment.
And the immediate domino effect of that is banks freezing lending across the board. Credit tightens globally. Speculative capital is wiped out by these cascading margin calls, and any surviving investors are forced into a strict capital preservation mode.
They just dump their risky assets to raise cash?
Exactly.
So the sinkhole doesn't just stop absorbing water, it reverses gravity and actively drains the rest of the harbor.
That's a great way to put it. As Hayes points out in his analysis, Bitcoin simply cannot rally in the short term if the entire world is taking serious losses from the deflation of the AI bubble.
Right, because everyone is hurting.
It forces a liquidity crisis. And in a liquidity crisis, correlations go to 1. Everything sells off together.
Having established that catastrophic downside risk, objective allocators really have to steelman the opposing view here.
We do. We have to look at the bull case.
What if this $1.5 trillion debt load is actually completely justified? To steelman the AI thesis, we have to talk about productivity.
Right.
The core assumption keeping this entire complex afloat is that earnings growth for AI companies will continuously accelerate into the future.
It has to.
Yeah, that is the only mathematical way to generate enough cash flow to pay off the interest on these massive data center capital expenditures.
And the fundamental metric that validates those earnings is token usage.
Token usage. Okay.
Are end users actually consuming the AI models at a rapidly accelerating rate?
It's like taking out $1 trillion loan to build the widest, most technologically advanced toll highway in human history.
I like that analogy.
Thanks. That staggering debt is perfectly justified, and it's actually a brilliant investment if and only if the traffic on that highway never stops growing.
Exactly.
As long as millions of new cars pay the toll every single day, you can easily cover the massive interest payments to the bank.
This raises an important question about the fragility of this ecosystem. In the AI world, the cars on the highway are the software companies paying API fees to use the models.
Right, the B2B side.
Yeah. But what happens if those software companies realize they're paying massive subscription fees for an AI integration that just, writes slightly better emails, but doesn't actually increase their bottom line?
They cancel the subscriptions. The token usage drops. And the moment the toll revenue no longer covers the interest payments on the data centers, the market instantly questions the viability of all this planned CapEx spending.
It all unravels. Hayes says bluntly that if the market stops believing the earnings will justify the infrastructure, it's game over.
The vulnerability is clearly defined around that traffic dropping. But in his reality test essay, Hayes identifies 3 specific catalysts. He actually calls them 3 darts, aimed directly at popping this AI bubble.
Yes, the 3 darts.
And these darts come from entirely different sectors of the global economy. So dart number 1 is higher energy costs.
If you are holding AI tech stocks right now, dart number 1 is the stealth risk you probably aren't pricing in.
Right.
It forces us to remember that the cloud isn't actually in the sky.
No, it's very much on the ground.
It is on the ground. Data centers are massive physical facilities that require an astronomical amount of electricity.
Yeah.
And right now, a huge portion of that baseline power is generated by natural gas.
The macro variable here is geopolitical. Specifically, the U.S.-Iran conflict and reduced traffic through the Strait of Hormuz.
This is critical.
If geopolitical tensions restrict the global supply of hydrocarbons, energy prices spike. Hayes models a scenario where oil hits $150 a barrel.
Wow, 150.
Yeah. At that price, the cost to generate the electricity required to run these AI models skyrockets.
Which directly compresses the profit margins of AI model companies like Google, Anthropic, and OpenAI.
Immediately.
Suddenly, it costs them drastically more to produce the exact same AI tokens, right at the exact moment they need to be showing accelerating profitability to justify their massive debt loads.
So dart number 1 attacks the profit margins from the supply side.
Right.
Dart number 2 attacks the equity valuations from the demand side, and this is float expansion.
Here is where we really need to translate some Wall Street mechanics.
Okay, let's do it.
Float refers to the actual number of shares of a company that are available to trade on the public market.
Right.
And we are staring down an upcoming wave of mega IPOs. You know, SpaceX, Anthropic, and OpenAI.
The giants.
These companies are collectively trying to raise more capital than all the dot-com IPOs combined.
Let's look at the SpaceX example Hayes highlights. Based on their S-1 filings, the implied valuation would have investors paying roughly 100 times sales.
100 times sales.
That would value SpaceX at $1.8 trillion, instantly making it the 7th largest company globally by market cap.
But here is the catch with the float.
Ah, the catch.
Initially, when they go public, only 4 to 5% of those shares will be floated to the public.
Just a tiny sliver.
Right. But that float is projected to increase 5-fold by early September as lockup periods end and early insiders are allowed to sell their shares.
Hayes argues this dynamic virtually guarantees market disappointment because of a concept called liquidity drain.
Liquidity drain, yeah.
When a $1.8 trillion company goes public, massive index funds and institutional investors are forced to buy it to mirror the broader market indices.
But where do they get the cash to buy billions of dollars of SpaceX?
Exactly. They have to sell other assets. They sell smaller tech stocks. They sell crypto. They just drain liquidity from the rest of the market.
Yep.
The global market simply cannot absorb that massive supply of new shares at those elevated valuations without starving everything else of capital. It's market indigestion.
That's the perfect term for it.
You just can't force-feed the market that much equity without something breaking.
And even if they manage to navigate the energy crunch and the IPO supply shock, there's a third dart.
Dart number 3.
And this one is purely political. Dart number 3 is the potential for anti-AI rhetoric entering the political arena.
Right. So Hayes looks specifically at Donald Trump potentially adopting an anti-AI stance ahead of the November midterms.
Yes.
The strategy would be to win over undecided working-class voters who fear job displacement from automation. And just to be absolutely clear here, we are not making any political judgments. We don't take sides on this deep dive.
No, definitely not.
We are strictly analyzing the market mechanics of political rhetoric based on the sources.
Exactly. And Hayes compares this potential scenario to a recent event in South Korea.
Oh, right, the Kospi event.
A politician there made similar anti-tech comments, and it sent the Kospi index nearly limit down, meaning it dropped so incredibly fast that trading literally had to be halted.
Just from comments.
Yes, just from rhetoric. before the government officially walked the comments back.
It just highlights how unbelievably sensitive these astronomical valuations are to the regulatory environment.
They are so fragile.
If institutional investors even begin to suspect the government might actively restrict AI deployment or, heavily tax data center energy usage, those future earnings models collapse instantly.
So we have the macro thesis, the absorption mechanism, the stakes, and the three darts in the air.
We've covered a lot of ground.
For an allocator managing a portfolio right now, how do you actually position yourself? We could look at the specific moves Hayes is making with his fund, Maelstrom.
But before we look at the specific plays, we have to establish the immediate catalyst driving these portfolio changes, and that is the Federal Reserve.
The Fed is always the catalyst.
Always. We have the upcoming June 16-17 FOMC meeting. The bond market is currently sending a very clear, very concerning signal.
It is.
The 2-year Treasury yield is currently trading more than 0.5 percentage point above the effective Fed funds rate.
That yield curve inversion implies the market is pricing in pressure for tighter monetary policy. It's setting up a hawkish hold by the Fed.
Wait, break that math down for me, because yield curves can get pretty dense.
Sure.
If the 2-year yield is higher than the overnight Fed funds rate, why does that specifically mean the Fed is trapped into holding rates high?
It's all about borrowing costs.
Okay.
The 2-year yield represents what the market demands to lend money over the near term. When it sits significantly above the Fed's baseline rate, the market is signaling that inflation and growth are too stubborn.
I see.
The market is basically doing the tightening for the Fed, telling policymakers they cannot afford to cut rates yet without risking inflation rebounding.
So the hope for cheap money is officially off the table.
Completely off the table.
Which acts as a massive headwind for both AI equities and the crypto market.
Yes.
Given that hawkish setup and the 3 darts aimed at AI, Hayes has initiated 3 distinct plays. Let's get into them. Play number 1, dumping altcoins.
Specifically, he noted exiting positions in HYPE, NEAR, WLD, and ZEC last week.
Right.
Interestingly, the ZEC exit was partially driven by a specific technical issue, the Orchard Pool bug. But the broader philosophy across all these exits is simple.
Which is?
In this environment, capital preservation is infinitely more important than capital appreciation.
If that AI bubble bursts and triggers the liquidity crisis we mapped out earlier, highly speculative altcoins are the very first things investors will liquidate to cover margin calls.
Exactly.
You absolutely do not want to be holding the most illiquid assets during a forced selling event.
Play number 2 is an active hedge against the very first dart we discussed. Maelstrom has moved into long positions on U.S.-listed energy producers.
This is a brilliant direct hedge against rising hydrocarbon prices.
It really is.
Whether there is a diplomatic deal with Iran or a prolonged conflict, the physical energy demands of these AI data centers are locked in.
They have to run.
They have to consume power. Buying energy producers is a way to profit off the very dynamic that might compress AI profit margins.
And finally, play number 3, core crypto holds. Despite the highly defensive posture on altcoins, Hayes is maintaining his core positions in Bitcoin and Ethereum.
Though, in classic Hayes fashion, he refers to Ethereum right now as dead but functional.
Yeah, that's a very Hayes way to phrase it.
So what does this all mean for you, the allocator, looking at your screens this week?
Good question.
The tactical stance seems to be step back, raise some cash by cutting the highly speculative altcoins. Hold your core blue-chip digital assets. Hedge your portfolio with physical energy producers, and then just wait it out. Hayes explicitly mentions planning to revisit the markets in early September after the dust from these mega IPOs finally settles.
It is a strategy designed purely for surviving the immediate shockwave. Because the underlying thesis isn't that crypto is fundamentally flawed right now.
No.
The thesis is that the AI capital absorption machine is temporarily suffocating it.
We've spent this entire time looking at the immediate near-term risks. The capital destruction, the credit tightening, the margin calls.
The scary stuff.
Yeah, the scary stuff. But we have to look past the immediate impact of the bubble bursting to the ultimate catalyst for Bitcoin.
This is where the long-term thesis remains incredibly bullish.
Right.
Hayes is adamant that while Bitcoin will undoubtedly dump initially alongside the broader market when the AI bubble pops, it will ultimately pump.
Because of how the financial system will be forced to respond to the wreckage?
Exactly. If the popping of the AI bubble triggers a genuine financial crisis, with banks taking massive losses on those data center loans and equity margin calls, policymakers really only have one tool left in the box.
The printer.
Yes. They cannot, under any circumstances, allow the banking system to collapse. They will be forced into a massive monetary expansion.
Hayes calls it the big print.
The big print.
The central banks will have to turn that massive fire hose back on, but this time, the AI sinkhole will be permanently closed.
Because the market won't trust tech valuations anymore.
Exactly. So when the Fed steps in to put Humpty Dumpty back together again, all that new forced liquidity will finally flow into the finite assets that actually survived the crash.
And that is the exact moment the true Bitcoin bid returns.
It is a fascinating sequence of events, and it fundamentally redefines the origin of systemic risk.
It really does. Historically, over the last few decades, global financial crises have almost always originated from purely financial engineering.
Right. We are talking about housing debt, subprime mortgages, and incredibly opaque banking derivatives.
Paper promises built on paper promises.
But if Hayes is right, the next global liquidity crisis isn't going to come from Wall Street engineering.
No, it's going to originate from the physical infrastructure of artificial intelligence.
Oh, it's going to come from server racks, cooling systems, natural gas pipelines, and stressed power grids.
Yeah.
It leaves you with a profound question to consider as an investor. If the next systemic crash is caused by the physical, real-world limits of building AI, how will that fundamentally change the way governments and capital allocators view technological progress versus financial engineering over the next decade?
It's a paradigm shift that will totally redefine what we consider a safe haven asset.
Something to mull over as you watch the energy markets and the PEC valuations this week. Thanks for joining us on this deep dive. Keep questioning the consensus, keep looking at the underlying math, and we will catch you next time.
That's your ION Investor Briefing. Stay informed every weekday. Subscribe now and download the ION app at aionpowerhouse.com.